So part 2 of 2. And we're going to begin with discussing transportation and travel. So we're still talking about self-employed individuals. We're still talking about Schedule C. So for transportation and travel, we know that in order for these deductions to be tax deductible, they need to be ordinary, necessary, and reasonable, which was discussed in my previous video presentation. Now we need to make the distinction between transportation and travel. So transportation is local transportation going back and forth from a workplace to another location for work versus travel, which refers to travel away overnight. So transportation, we are talking about, and I think this slide probably it's better. You may want to refer to your textbook, Exhibit 6-4. We can see that we have the home on the left and we have the office on the right of the screen. And then moving from our home to our work location, it's deductible. Going from work to another work location is also deductible. Now, going from work back home, that will not be deductible. Neither is from the office to the home. Okay, so from a temporary work location to the office, that's deductible. Office to another work location, etc. So for example, let's say you're an auditor, you're working for a public accounting firm. So you traveling or driving to the client's location. Usually audits are conducted at the client's business place. So that will be deductible. You going from that client to another client, that will also be deductible. You going back to the office will also be deductible. Now, you going back home at night or after you completed your job, that is not deductible. Automobile expenses, and so we're talking about these transportation costs, we're talking about automobile. So for automobile expenses, you actually have two choices. We can do the standard mileage, which was 54.5 cents for 2018 or 58 cents for 2019 versus actual expenses. So for the standard mileage, you simply take your business mileage times this 54.5 cents per mile to figure it out your automobile expenses. Actual expenses, you have to keep track. You will be able to take depreciation on the vehicle. And then you have to keep track of your insurance, your tires, your gas, and all that. And then multiply by the business use. We're going to go through an example shortly. So once that we take depreciation, then we cannot go back to using the standard mileage. So once we take the depreciation deduction under actual expenses, we have to stick with actual expenses. So here's an example. We have Ed who purchased a vehicle. He's using a 60% for business. Now, how did he make this determination of 60%? Is because he took his 14,000 business miles divided by the total miles that he drove for that year. And that's how he came out with the 60%. And the 60%, he's gonna use it to multiply it against his interest and his taxes. And then he takes a standard mileage rate for the 14,000 of business miles. If we were to do actual card expenses, then like I said, we can include depreciation, gas, oil, tires, etc. And he will have to multiply those by the 60%. Travel costs. Now travel, we said, is defined as staying overnight And the importance of that is that we can deduct meals and lodging and other incidental expenses. So if we had to take a taxi, our ticket, all that could be included as travel costs, as long as they are not lavish or extravagant. If you're going to take a cruise ship to go do business, then that's probably not going to be deductible. So meals are always subject to 50% deduction limitation. So if I spend $100 on meals, I'm only allowed $50. I can only deduct $50 for tax purposes. In terms of meals, we always have to keep track of the 4Ws. What was discussed in this business meeting, where took place, who did we meet with, and when. So what were the objectives of that meeting? So all that has to be stated. Remember, that is the taxpayer's burden to prove that these deductions are valid. Business entertainment starting in 2018 is no longer deductible, so we don't have to worry about this. There is a per diem rates that business or people can use, taxpayers can use, is based on the continental standard rates, and you can find these online. Usually it's called CONUS. And so, depending on what city you go and what place in the world you go, they will have a per diem rate, which includes meal. And again, meals are subject to 50%. So we have some examples here. Example 6-24 refers to a taxpayer who did not stay overnight and therefore cannot take the travel expenses, but it can take transportation costs because this was for business. We also have another two examples. The first example, the taxpayer visited his parents for 7 days and then took like a day or so for business. So his ticket will not be deductible because the trip was primarily personal. In the second example, 6-26, we can see that the main purpose of his business, of his trip, was business, and therefore he is able to deduct the cost of his ticket. So a taxpayer can take depreciation on a business auto and use a standard mileage rate in the same year. This is false. Transportation costs are allowed only when the taxpayer visits a client. That's not true. A deduction is allowed for meals, lodging, and other incidental expenses when a taxpayer travels away from home, requiring sleep, overnight. So this is true. We talked about the per diem, which is still subject to the 50%. And then taking a client to a Major League Baseball, this will not be deductible because that's entertainment. A taxpayer can also, if it's self-employed or even for rental activity, they can take business use of the home as an office, so home office, in other words. If it's exclusively used for the business, has a regular use, and they don't necessarily have to see customers or clients at this location, but it should be the only location that they have available for this purpose. Before 2018, employees were able to deduct office expense, but this is no longer applicable, so you don't have to worry about this. So office expense or the office home office deduction has to be reported on Form 8829. So, and then the result of Form 8829 will flow to the Schedule C at the bottom of Schedule C. So you may want to search Form 8829. I think there's also an example in your textbook. So take a look at that and how they inputted the direct and indirect expenses. So in order to figure it out, the indirect expense calculation we need to figure out the square footage of the place of the office versus the total square footage of the home. So for example, right now, I'm using this spare room as my office in my home, given the circumstances. So let's say, I don't know, my home is 1,800 square feet. And so I'm using 300 square feet for this office. So 300 divided by the 1,800, that will be the percentage that I will use to deduct indirect expenses. Direct expenses, on the other hand, are 100% deductible. So any expenses that I have for this business, I have to buy a desk, I have to buy a chair. I'm still waiting for things that I order through Amazon to facilitate, make it more comfortable for me to stay in this office. Those are direct expenses. Indirect expenses will be, for example, my mortgage, my utilities. Okay, those are indirect. Home office deduction is limited to business income. So just like the Section 179, we cannot create a loss from the home office deduction. So we first deduct anything related to anything related to, for example, mortgage and real estate taxes. And then we are going, if there's anything left after that, then we're going to deduct our insurance, utilities, and depreciation. Of course, direct expenses go first too, right? Now, in terms, because we're using a percentage, right? So let's say we're using 10%. Okay, I decided that the area of my home office is 10% of my home. So 10% of the mortgage interest will be deducted in the Form 8829. 10% of real estate taxes will be deducted in Form 8829. But what about that 90%? That 90% will be deducted in Schedule A if I was itemizing. If I'm not itemizing, then they're not deductible because I'm taking the standard deduction. So just keep that in mind. Okay, so here we have example 6-29. We still working with, I think his name was Tim, and we have his trade or business expenses. We have his mortgage interest, and then other expenses related, including the depreciation. He had established that he was using 50% for business use. Okay, and so remember that. He's using his home. This is a residential, and so he's using the 27.5 years to depreciate it, and that's where the 2.461% comes from. And probably we have to go back to previous examples to see when did he start to determine the month. So we have that, we have his gross income, so we're going to deduct his direct expenses, and then we have 50% of the mortgage interest and 50% of the taxes. And so he is now limited in the deduction of 50% of utilities, insurance, repairs, and his depreciation to the $1,500 because he cannot generate a loss. Now, any amount that was not deductible in the current year, you guessed it right, it's going to carry over to the following tax year. We have business bad debt expense that we can also or are able to deduct on our Schedule C. There is very strict rules in terms of the determination of worthless. When is actually a debt considered worthless? So it just has to do with timing. So we're not, this is not something that we're going to include in your exam, but just to give you a general idea that we're able to deduct business bad debts, which is different from personal bad debts, and that's other type of restrictions, which we'll probably take a look at when we're looking at capital gain and losses. Business casualty losses, just that we're looking at itemized deductions. We have casualty, theft, and casualty losses. Pretty much the same because we're still talking about an individual. So they're still limited to 10% of the AGI. And they will receive an ordinary loss because this is a business. So, for example, here in Guam, we have so many typhoons, and so if there's any losses from as a result of a typhoon, then they will be able to deduct it here. Also, remember that you have to look at the fair market value before the typhoon and then the fair market value of the asset right after, and see what that difference is, because that will determine the amount of the loss. And this will be further reduced by any insurance reimbursements. Okay, so we have some examples here. We have Jose uses 20% of his house exclusively for business, so he has a home office. He has decided to paint the exterior of his home and also his home office, and he spent $3,000 for the home and $500 for the office. Now the $500 is a direct expense, so the $500 will be fully deductible. The $3,000 pertains to the entire home, so the $3,000 is subject to the 20% allocation. So in this case, the correct answer is D. You can answer number 2 on your own, and you can just check the presentation anyways. When business property, well, we already talked about this, so I'm not gonna go over it. Now, I just wanted to touch on hobby losses rules. A hobby, this is different from an actual business, so that the person does not entirely depend on the income that is generated from this side business. So it's considered a hobby. So we're looking at 3 years. If within 3 years this person keeps generating losses from this business, then this is probably considered a hobby. In that case, usually it's individuals or taxpayers that may have a full-time job, and then they have something that they like to do on the side for extra money. So that's not necessarily their main source of income, and therefore if they keep generating losses, then it's a hobby. Now the hobby losses were eliminated in 2018, or starting in 2018, but the income must be reported. So unfortunately, you're not able to deduct the expenses, but you have to report any income that's generated from hobby. Other expenses that are deductible on Schedule C could be education expenses. For example, for certified public accountants have to keep up with continuing education. In fact, they're required to have 40 hours of continuing education per year. And so these continuing education, the cost of these continuing education courses are deductible as education expenses on Schedule C. Okay, so this is different from the educator's expenses, a 4 AGI deduction. This is different from tuition deduction as a 4 AGI deduction. This is we're still talking about Schedule C, self-employed individuals. But if the education expenses will qualify the taxpayer for a new trade. So for example, I'm a CPA and all of a sudden I start taking courses on, what can I take on? Engineering. Okay, so I'm taking courses on engineering. So this is going to qualify me for a completely different trade, and therefore they will not be deductible. Maybe the tuition could be deductible as a 4 AGI deduction, but not on Schedule C. Okay, so if taxpayer has shown a net profit for the last 3 years, the activity is not considered a hobby, and this is true. Okay, so a tax can never take a loss on an activity considered a hobby, and this is true also. Expenses that can be deducted elsewhere on the tax return must be the first expenses deducted from hobby income, and this is true. Education expenses that have qualified. Okay, so you guys can go over these on your own time. We have discussed self-employment tax before in class several times, so you may go ahead and take a look at this. Just remember that Social Security has a wage cap. You may want to check the wage cap for 2019. But Medicare does not have a wage cap. Remember that you have to take the net profit from Schedule. So you may want to take a look at Schedule SE. And you take the net profit from the Schedule C and you multiply by 92.35% before you apply these tax rates for Social Security and Medicare. Being aware of the Social Security wage cap, which is also stated on the Schedule SE. So take a look at that because it walks you through the calculation for self-employment tax. And then recall that half of the self-employment tax is a 4 AGI deduction. Okay, so you can go ahead and check your knowledge by going through these examples. That you still have the PowerPoint in Moodle. The last topic that we're talking here is the qualified business income. This is new with the 2018, starting in 2018, where we are allowed to deduct the lesser of 20% of QBI or 20% of taxable income less net capital gains. So this is if we have self-employment income or if we have a pass-through income. Now we haven't talked about flow-through entities yet, but when we're saying pass-through income or flow-through income, we're talking about partnerships, we're talking about LLCs that are treated as partnerships, we're talking about S corporations. And we'll discuss more this later in the semester. If the taxpayers are above the threshold, so there's a limitation on income, then there's gonna be a W-2 wage limitation. What I mean by this is, for example, we have Allison made $600,000 in QBI from her S corporation. Manufacturing business with 1 million in depreciable assets, and Allison's W-2 wages are 150,000. She is above the 415 threshold amount, so it has completely phased out. So the IRC Sec.199A, which is the QBI deduction, is limited to 75,000. How that was calculated is based on we're gonna deduct the lesser of the 20% of 600,000, the flow-through income from the S corporation, or the greater of 50% of 150,000, which is for W-2 wages, or 2.5% of the 1 million plus 25% of the $150,000 in wages. So the greater of those two, the 50% of the 150 or the 2.5 of the 1 million plus the 25% of 150 wages, the greater of those two, which ended up being the 75. And then we compare that 75 to the 120. And the lesser of those two is the amount that we're going to be deducting. So in this case, the 75,000 is the lesser amount. Once again, if you have any questions, well, actually, I'm going to require you to post your forum questions probably by March 31st, just to give you a 1 week break for spring break and to adjust to these online routine. So I'll be sending you a Moodle information through Moodle.